Hello, I'm Joe Hoyle speaking to you from the University of Richmond, and in today's lesson we're going to look at the statement of cash flows. There are typically four financial statements: income statement, statement of retained earnings, which really in real life is usually a statement of stockholders' equity, the balance sheet, and now a statement of cash flows. These first three financial statements, income statement, statement of retained earnings, and the balance sheet, come from T accounts. You simply take the ledger, take the T accounts, and you put them on the right statement. Rent expense goes on the income statement, accounts receivable goes on the balance sheet, dividends goes in the statement of retained earnings. It's a placement type of thing. The statement of cash flows is different, and that's why I have held it until the end here in the last chapter in the textbook. And the reason is the statement of cash flows comes from the income statement and the balance sheet, and of course the cash account itself. So to me it makes sense that once you have come to understand what's on an income statement and once you've come to understand what's on a balance sheet, now we can take that information and we can make a statement of cash flows. And to tell you the truth, some of the most important information in an entire set of financial statements is on this cash flow statement. A lot of investors, a lot of decision makers will tell you that the cash that comes from operating activities is one of the very most important pieces of information in any set of financial statements. Where did this company get its cash? How much cash was it able to generate from, in this case, selling ice cream? That's important information. If eventually you cannot get cash from what you're doing, you probably don't have a very long life expectancy. So I want to look here at the statement of operating activities in the statement of cash flows. Your roommate's parents, as we know, run ice cream stores in Florida, and the roommate has looked at their financial statements, and by luck is looking at the statement of cash flows and looking at the operating activities. The roommate notices something that's very interesting. Now remember, this is a statement of cash flows, and the roommate is looking at the operating activities. The roommate sees depreciation expense. We all know what depreciation expense is. It's a cost allocation process. The equipment, you take the cost and you allocate it to the income statements over a period of time when it will generate revenues. You take the buildings, you take the machinery, and you allocate that cost to an expense account, depreciation expense, over a period of time. The roommate understands that that's not a cash transaction, it's a cost allocation. However, when the roommate looks at this statement, the roommate sees depreciation expense as a large positive number. And the roommate's question is one that I encounter a lot with my students. How can this possibly be a large cash inflow? Depreciation expense is not generating any cash. I always say there's a few numbers on a set of financial statements that typically mystify people, or they simply don't understand what they mean. And I think this is one of them. Depreciation expense showing up in operating activities as a large positive number. So I want to make sure that you understand why that is. The textbook points out that there are two ways to present the operating activities. You can do it by the direct method or the indirect method. FASB prefers the direct method because I believe it's more easy to read and understand. However, in the United States, virtually every company uses the indirect method. So your roommate is looking at a statement of cash flows operating activities created by the indirect method. And the indirect method does a couple of things. The indirect method starts with net income and then begins by removing any non-cash items in net income. If you only want cash from operations and you've got net income, then you need to begin that process by removing the non-cash items. Well, in most financial statements, the largest non-cash item by far is depreciation expense. It's a huge expense for some companies, and it's in net income, but it's not cash flow. So it is removed. Now, how do you remove depreciation expense? Well, you always ask yourself, how is depreciation expense in net income? As an expense, it's in net income as a negative. It's an expense, it's a negative. How do you remove a negative? If something is a negative and you want to remove it, you eliminate it by adding it back in. So when your roommate sees depreciation expense added in, it's not that it's a cash flow at all. It's being eliminated from net income. Because ultimately, what your roommate's parents want to report is how much cash they got from selling ice cream. So what they really do is three things. They start with net income, they eliminate the non-cash items, they eliminate depreciation. If it's a negative, they add it back. They then eliminate any non-operating items in net income. You'll have some gains and losses. They might have a gain from selling a refrigerator or a loss from selling a building. Those things are in net income, but they're not part of operations. They have to be eliminated. Eliminate the non-cash, eliminate the non-operating. After you do those two things, the numbers that remain, sales, cost of goods sold, rent expense, and the like, are all accrual accounting numbers. Revenues are recognized at substantial completion. Expenses are matched with revenues. They are not cash numbers. So you have to take the changes in the balance sheet accounts that relate to those accounts and use them to convert the accrual accounting numbers to cash. So there are three steps in the indirect method. You start with net income, and first, you eliminate non-cash. Second, you eliminate non-operating. And third, you convert the accrual accounting numbers to cash. Often the biggest adjustment is the one your roommate noticed, and that is the elimination of depreciation. Why is that so unusual? Because you're adding it back in. It makes it look like you're getting cash, but all you're really doing is eliminating the number. I'm Joe Hoyle. This is the last chapter. We're going to make sure that you understand the statement of cash flows. One of the major effects is the addition of depreciation to eliminate it. Have a great day.